So when this bubble breaks, and we think it's about to really break in a way that is like headline gathering, and it could very well show itself in the next few weeks, I think that's going to panic the central banks.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 16th through September 23rd, 2024, while supplies last. This week, we have a very limited supply of Pamp 1-ounce silver rounds at just $2.75 over spot per ounce. We also have 1-ounce gold Rand elephants from the Rand Mint in South Africa for just $59 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Thanks, Elijah.
Today we had the Fed announcement that they are going to be cutting interest rates by 0.5%, so 50 basis points. This was higher than a lot of people were expecting. Gold initially rose dramatically on the announcement and then sold off sharply. Your perspective on how markets reacted?
I would ignore today, no matter what side of the market you're on. Okay. First off, everything acted the same way. If you look at an hourly S&P, an hourly silver, an hourly gold, they rallied on the news, then they collapsed on the news. Okay. It's noise. Okay. There's bigger stuff going on. First off, the markets don't go together. Gold and silver, T-bonds, so forth. T-bonds, for example, sold off also. Well, our assessment of the major trends is that T-bonds have now joined gold on the upside in a major advance. Okay. T-bonds are likely to surge, drop in yields for the next several quarters. That occurred a month or so ago. They broke out over a major, what we call a quarterly momentum base. See it on momentum, not on price. Gold already broke out in late March, so did silver, so did gold miners. Then they paused recently and then surged to a new high today. Miners got over 40 on GDX, for example. Gold touched 2,600 on the front month contract, October. And the S&P had a surge as well today as soon as the news came out, and then the sellers came in on all the markets. So unless you think they're all going together at the same time in the same way, today is noise, okay? Now, there's some big stuff going on here that is opposite, okay? We think gold and silver are going to continue higher. Today's wobble doesn't impact us one bit in terms of our assessment. We think the stock market is topping and has a very, very dangerous situation below it that could easily come into play next month, meaning starting in a week or two. And the T-bond market pullback is meaningless. The T-bonds are in a fresh upside mode, meaning asset managers this time around have viewed T-bonds as a place to be other than the stock market, just as they've viewed gold miners to be that way. So anyway, I would ignore today. That's my technical assessment.
Now, when it comes to how markets are probably going to be reacting in the coming days, you recently reported that silver and gold have both broken through key momentum levels. Can you expand on that?
The process of correction in gold and silver that occurred after their surge in March and April, in the case of silver, March, April, and May, silver continued up a month beyond gold. Then we entered a multi-month correction in silver with some downside pain. And for gold, basically a yawn sideways in about $100 range, just up, down, noise, in other words. But a congestion period where the gains that we saw, dramatic gains in about a 6-week period in March, April into May, corrected. And we had a pause, profit taking, shorts came in, doubted the market, et cetera. We think that ended last week's action, ended that process. In the case of silver, silver went up. If you measure from the low of last week to the high, it was over a 10% upturn, literally within a week. Okay. Gold had a little bit more than a 4% upturn from its low of the week to its high of the week. So they both said, I'm out of here. Okay. The congestion process that we saw, multi-month process, we think is over now. Now the question is more dynamics on the upside, and I think it's coming. Today is noise. Ignore today. I don't think today disproves that argument whatsoever. In the case of the stock market, we have a situation that is, I don't want to pound the table yet, but in 1987, I caught the crash. I was a broker at the time, independent broker, and I caught it in a small way with puts, okay? I didn't make a fortune, but I made a huge percent gain in a very short period of time with some puts. And it taught me a lesson, because what I did it based on was quarterly momentum of the S&P 500, not its price action. Price action of the S&P looked just like it does now, just upward, pull back, upward, pull, just happy market going all the way, going to go forever, you know. You pull back a little bit in early October, the new quarter in 1987, and though price didn't pull back in any meaningful way, when you looked at the price chart, you weren't breaking a thing. Quarterly momentum was blowing a floor that had established over a 2-year period, where if you looked at the quarterly momentum, it just kept coming back to the same horizontal level over and over, and finally in early October broke it, and you crashed. It was a surprise that nobody caught. It was a panic beyond panics. It happened back then. I've gone back and researched it. Gold was in a non-trending situation then, really. But gold during that bad week went up 7%. So somebody didn't tell gold it was supposed to go down if the stock market crashed. Anyway, keep that in mind. Because I know everybody thinks that if you ever get an event like that in the stock market again, and we have the setup for it now, I'm not saying it's going to get triggered, but it's about 4% below where the NASDAQ 100 is right now next month. You don't want to be there. That therefore silver and gold must go down. And I think it's going to be a very interesting hypothesis because factors have changed, technical dynamics have changed, and I don't think that's going to happen. And if you think it's going to happen and you're long silver and gold, then I suggest you should better buy some puts on the S&P if our trigger numbers are hit. Okay. Anyway, I think we're about to move into very dynamic markets.
It seems like you're saying this time when it comes to precious metals in the stock market, they're not going to be correlated. We've seen over the last couple of years, it seems like a strong correlation, but you're thinking that is ending.
There's not enough examples in history to make the case that this is a recurring event, okay? There is one distinct example everybody really remembers, and that's October of 2008, when the stock market had already been in bear trend for over a year, and it sharply declined already. And then in October, it had a puke month where it went down like 30% real quick. At that point in time, though, silver and gold had been advancing as the stock market bear had been underway for a year. They had been advancing. And when you looked at silver and gold's technicals at that point, they justified a sell-off that happened to be coincident with the stock market. In other words, they needed a correction. We could see it on the charts that it looked like they were going to be vulnerable too. We do not have that situation now. Plus, I think the fundamentals are dramatically different.
Can you expand on kind of right now, obviously, we're seeing wild moves in the stock market, but how do our viewers maybe take a look back and understand, as you mentioned, that today does not matter when it comes to market reaction?
Yeah, the Fed funds days, you go back and look at them and circle them, go back to last year. And then when you get these rate rises, or then you get the pause, or then you get, quite often it's noise. It's not ultimately determines the trend, okay? And a lot of people like to pin it on that. Today was a bit of surprise, not much, in that everybody knew the rate cut was coming, okay? Back in 2007, same week in September 2007, the Fed cut rates by 0.5 point, and it shocked everybody. It was the first rate cut in a couple of years, and nobody expected it. So it was an ambush. And the stock market shot up for the next about 3 weeks. It went up another 7% in the S&P, and then it topped and we went into a massive bear market. So the Fed cut rates for the next couple of years even, and it didn't matter. The bubble was broken, the market went down, they could cut rates, it didn't matter. But this time it's different in that we've known they're going to cut rates. They've said so. So the rate cut itself is not a surprise. It was a bit of a surprise that it was 0.5 point, given that Powell assures us in his patronly manner, his fatherly manner, that the economy's in good shape. So, well, why the hell did you cut rates by half a point? So anyway, so some economists were actually a bit upset by that, in that they thought, well, that's what does that mean, Fed? If everything's so good and we think everything's so good, why did you cut by half a point? So that probably concerns some people today, justifiably. We see the situation now is different, though, in that the bubble in the stock market is the biggest in our history. No stock market has had a 15-year bull trend. It's amounted to 7-8-fold increase in the S&P and a 17-fold increase in the NASDAQ 100. No bull market prior to that, not the 29 top, not the 1970s peak, not the 2007 peak, not the dot-com top. None of them matched the extremity of this bubble. And it's easily explainable. You look at a Fed funds rate chart, money was free for about a decade. What do you want? The money went somewhere, okay? And it helped create a bubble. But the other side of that is when the Fed does decide finally to alter policy, it's never helped in those bear markets either. In January of 2001, for example, 6 months off the high, the dot-com high, the Fed cut rates twice, the first day of January and late in that same month, literally 6 months off the high. We weren't even in a bear market then. And the market continued to collapse for 2 more years, big time. And they cut rates all the way down. 2007, they cut rates in September, market peaked 3 weeks later, they cut rates all the way down. The bubble continued to break. That back then it was mortgage-based. Prior to that, it would have been the dot-com. Now it's many things. It's not AI. AI is only the recent headline. It's a lot of factors in play here. So when this bubble breaks, and we think it's about to really break in a way that is like headline gathering, and it could very well show itself in the next few weeks, I think that's going to panic the central banks, not just the Fed, into all those things that they do to degrade the underlying value of the money unit ultimately is the consequence, and that ultimately is what drives gold in the long run.
It seems like, at least if you look at the official numbers, and we've talked about this before, that the Fed has remarkably engineered a soft landing, but that seems to be about to change in your view.
Well, I think that, nobody expects a market decline now of significance, okay, especially anything rapid. I think that would ambush everybody if that happened. We think the potential is there. We'll be very specific in our reports over the next week or two, especially as we get into next quarter, because our numbers shift then. It's a new quarter, new numbers change. And the vulnerability gets very clear at that point. If the market even sneezes, it could blow the bottom out of it, which would ambush a lot of people, probably even political people, because one side would not like that event, okay, if that happened prior to the election. If people are already in pain due to this or that factor, including higher prices and so forth for basic materials and goods, if their retirement account suddenly shed 20-30% rapidly, the pain would be horrific. But anyway, the Fed is obviously concerned about something. They have justification for being so, even though they never admit it. And I think gold and silver have known this all along, that ultimately the central bank is going to go berserk to defend this breaking bubble. And they're ahead of the game. Gold's not waiting for the bubble to break and the Fed to respond. It knows it's coming. And I think that's where we are right now.
That seems to explain the record prices we've seen, $2,600 gold and, silver back above $30. I mean, it's amazing how high gold has sustained, or how high gold has risen, and it's really sustained and made new highs continuously in the last couple months.
Yeah, and GDX did today as well, gold mining sector. It had stopped short of 40 repeatedly, and it blew over 40 today. Now, they sold it off, yes, along with they sold everything today. Ignore that. But it did make new highs today, too. And silver was back up to 31.5, not far from its highs. Its prior peaks in silver in May, which was much higher than gold's peak in May. Gold peaked in April, and silver went on up into May. Silver got above 32 then. and dropped back down to about 29. And it got above 32 again in, I think, July. And then you had the big sell-off into August. It got down close to 26. So really a deep cleansing. And you came up off that low pretty rapidly. And last week you were down to about 28. Next thing you knew, you're 31. Boom. So silver and gold have declared that process is over. The issue now is what's on the other side of this. And I think it's going to be very dramatic. We've got some tentative numbers that we're paying a bit of attention to. They're not a top. We don't expect a top in gold and silver. We don't think we're in 1980 in gold where you peak, or in 2011. We don't think we're in that situation whatsoever. We think it's likely to continue for another year or so. But in the immediate run, we could see a dramatic surge. And I think that the dramatic surge, for example, if you get silver back to 32 a third time, now think about this. If you're a point and figure guy, you keep it X's and O's, upticks or X's, downticks or O's. You went up to 32, back to 29, downticks, back to 32, double peak, dropped down and took out the 29 low and went to almost 26. So the point and figure chart broke down, cleared itself out, and shot back up now to 31. You ever touch 32 again? That's what you call a pending triple top breakout. And I bet you touch 32, you're not going to stop. You're going to blow through. I think the surge in silver could carry us well over 50 rapidly. Now, that sounds ludicrous. Well, right now, there are some brokers out there, big brokerage firms, that are talking 3,000. That makes me a little nervous because, frankly, that's sort of a minimal pause point for us. So let's just assume gold in this surge is going to go to 3,000, which is another $400 beyond where we've reached today. Okay. If silver, during that same process, were to take its spread relationship to gold, which is now above 1.2 and pressing toward 1.3, if it were to go to 2%, which if you go back over the last 50 years and look at the silver-gold spread, price of silver expressed as a percent of gold, you'll see there are many, many years in that 50-year time where we reach 2%, 2.5%, even 3%. Okay, so it's not abnormal. If silver merely went to 2% again, which again is a level we've seen so many times in the last decade, for example, it's ridiculous. It's normal. Silver would be $60 if gold were 3,000. So I think that silver's dual highs that everybody knows about at $50. We get up through this recent stuff, we've been up to 32 again, and blow through that. I think that surge could carry you up into the mid 50s at least, well beyond the $50 peaks that everybody knows about. And I think that's the potential for this pending surge that I think we're on the doorstep of.
And what about the bank stocks as well? I know you track those very closely. And when it comes to this impending stock market crash, how do you see that those being impacted and also the banking system?
We look at all the sectors. The bank sector, by the way, now some of the banks have made new highs, some of the biggies. Okay, they've made new highs along with the S&P. But the KBE has not, the banking sector ETF. But forget that. The banking sector, when we run our quarterly momentum, which is a long-term trend metric, in other words, we don't measure S&P versus it's this week or that week. We focus on changes in the three-quarter moving average and price in relation to that. And we've seen that over the last 2 years, the lows we keep making in the major indexes, especially the NASDAQ 100, the leader index, have repeatedly come back down to the three-quarter average. So when you look at price, you see this upward curve in S&P and NASDAQ. And by the way, NASDAQ's not near its highs. Nobody's talking about that. The leader index is not leading anymore. S&P made a new high. But when you look at the quarterly momentum, you see a totally different picture than when you look at the price chart. Price chart looks glorious, like it's just going to keep going up forever. You don't see any particular point that says I should panic. But when you look at quarterly momentum, you have a 2-year wide floor that's been hit like 3 times. You don't want to go back there again. You nip that floor out and the bottom will come out rapidly. Very same pattern occurred in 1987 and has occurred a few other times in history, including 1929, by the way. So it's the kind of technical event that we're very acutely aware of. It doesn't have to break, but if you go down to it, you're not going to hold it. And that number for the NASDAQ is like 4% below where you're trading right now, applicable next quarter, which is, a few weeks away. If you see that, you could see dynamics change in the stock market in a way that very few people, if anybody, is anticipating. And therefore, the data points that are softening, like the employment numbers that the Fed is concerned about, could soften rapidly because they usually follow the stock market. They don't lead it. So anyway, it's something to watch. And I think that's a dynamic that will impact other markets like the T-bond market, gold and silver, et cetera.
It will be interesting to really continue to track this with you. It's an interesting day, but it's important, as you mentioned, to look at the kind of long-term impact of all of this. If our viewers are interested in learning more and tracking momentum with you, where can they find you?
Oliver MSA for Momentum Structural Analysis, olivermsa.com. Request some samples. In particular, the next few weeks, we're going to be heavily focused on defining that situation in the stock market.
Fantastic. Well, thank you so much, Michael, for this last minute update with you. Really appreciate it, and you have a great day, and God bless.
You too.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 16th through September 23rd, 2024, while supplies last. This week, we have a very limited supply of Pamp 1-ounce Silver Rounds at just $2.75 over spot per ounce. We also have 1-ounce gold Rand Elephants from the Rand Mint in South Africa for just $59 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.